Raychaudhuri then on the show with us. Manishi, hi, good morning. I guess festive cheer everywhere, be it global markets, be it Indian markets. But the question is, what do you do next? Don't fight the trend, continue to ride the wave, or is it time to get a little bit cautious at least?
For India specifically, while we have the market trading at historic highs, not just in absolute terms, but also in terms of valuation, there's the underlying trend of earnings estimates that also seems strong. There's a vast swathe of sectors which are seeing earnings estimate upgrades now, and we think that that trend is likely to sustain for the foreseeable time horizon, which means that certain valuations which look expensive today may not appear so expensive tomorrow once those higher earnings estimates are taken into account. What are the risks? I think they predominantly arise from much higher fuel prices than one could have anticipated if oil prices go up even significantly higher from where they are today. Obviously, that would have a negative impact on current account and therefore on the currency. In fact, what I would like to point out is that over past 2 weeks or so, the market has actually corrected indirectly through the currency route because the currency has depreciated about possibly 3 to 5%, 3 to 4% rather. And that has indirectly led to a correction in the equity market already from a global or international investors' perspective. So, I think these are the things that investors would have to be mindful of. But for now, given the earnings momentum is strong and even the initially reported numbers are coming out to be, possibly better than estimated or at least in line, that momentum should sustain for now.
Right. Manishi, I wanted to talk about the performance from IT majors. I mean, everything from a Mindtree to an Infosys upping its guidance, where HCL Technologies over the weekend reporting an inline set of numbers. How does the pecking order now stand for IT? And while the valuation gap has already begun, narrowing, would you think that there's any threat to TCS being in the pole position? I mean, could Infi or an HCL Technologies or a Tech Mahindra take over?
Well, I wouldn't comment specifically on stocks, but we do like the IT universe, the Indian IT universe, quite a bit. We have a very significant overweight on that sector in our Asian model portfolio. And we are really focusing on the top 4 or 5 companies. We think that this momentum in order flow that we are seeing would possibly disproportionately benefit the larger companies. They have the wherewithal, they have the ability to execute those large orders. They also have the ability to squeeze out margin benefits from the work from home, remote working tendencies that are likely to sustain for some time. So it's, if investors focus on maybe the top 4 or 5 companies, possibly paying some attention to relative valuation, they would have a winning recipe on their hands.
Can you define what is right for IT? Because it's a sector where growth is back. It's a sector we know margins in a sense are still maintained and cash is coming back via the dividend or the buyback route. What is the right P multiple for a sector which is, let's say, growing in 14-15%?
Right. See, currently, as far as current forecasts are concerned, I mean, it's like 14 to 15% growth, as you pointed out, is possibly baked in. But at the same time, for the frontline companies, those numbers could actually be revised upwards going forward. I mean, I wouldn't be surprised if we see late teen kind of growths for some of the large frontline companies. And given the fact that the return on equity and return on capital of these companies are significantly higher than the market average or even the service sector average, I would think that the present valuations or maybe the early 20s kind of P multiple would not be a stretch for this sector.
Do you think there is scope for P multiples not to expand further in consumer names?
Well, consumer names, and as as you would know, that the consumer names have, many of them are trading at possibly 40 to 50 times or even more. So there, I think investors would have to be far more selective than, let's say, the IT sector as far as paying attention to valuations are concerned. Now, that said, we must also remember that the consumer names have always been expensive, and India is a market that rewards quality. If you want high quality companies, if you want companies that are likely to have sustainable earnings estimate upgrades, if you want companies that have significantly higher ROE, if you want companies that are consistent compounders, then investors would have to be prepared to pay a valuation premium. So yes, I think in the consumer name, investors would have to be selective, but at the same time, the top rung companies which are able to pass on the cost increases to their customers, they would continue to remain in focus.
Good morning, Manishi. About a month ago, you said and you conceded that while the stars were getting aligned for the market, the straight line rally has taken you by surprise. After that, we've also seen an overweight position being given to India. My question to you is that as you go overweight now on India, what are the new sectors you're looking at? In the past, you've spoken about IT and financials.
Right. So IT and financials continue to remain, some kind of a core overweights in our Indian allocation in the Asian model portfolio. We have also increased exposure to the auto segment, and this was about month to month and a half ago. It has actually paid significant dividends in terms of outperformance compared to other Asian peers. We also like some of the commodity plays. Some of them are conglomerates with exposure to oil refining, telecommunications, and what have you. But in general, the commodity plays, auto plays, and the top rung consumer discretionaries, those are possibly the sectors that I would highlight in addition to IT and financials that you already talked about.
So if I were to see an auto in the recent performance, let's say of a Tata Motors or an Eicher, Ashok Leyland, this is a sector you're going to continue to bet big on? Is it just because, a lot of them are maybe getting into hydrogen, into green energy, or you see genuine demand?
There is a clear economic recovery that has taken us by surprise. And I think for most market participants, it has worked out that way, that after the second COVID wave, expectations had been beaten down, both in terms of economic growth and in terms of earnings growth. Expectations had been beaten down to such an extent that the outcome actually took everyone by surprise. And we think that that's likely to continue for longer. We are already seeing that percolating down to domestic demand. There are quite a few supply side measures that's been adopted by the government. It's not been very actively discussed in the international press, and the impact obviously would be long drawn out. It's unlikely to happen right now. But these are some of the things that would percolate down to investments as well. So we think that after quite a few years, after possibly about 7 to 8 years, we are now entering a capex cycle. We are entering a period of domestic demand revival, though the bottom of the pyramid still needs some work in terms of economic incentives. But broadly, these have contributed to a broader economic growth, which was unanticipated even a few months ago. Those are the factors that lead us to remain positive on the sectors that I highlighted. And it's clear that they're also getting reflected in earnings estimate increases across, across a wide variety of sectors that I earlier talked about.
Sure. Manishi, from the 2020 lows, the two sectors that emerged as the first winners were Nifty IT as well as Nifty Pharma. Having said that, while IT continues to maintain its pole position, I can't say the same about pharmaceuticals as a sector. I was just looking at the last 3-month performance of these sectors, and while IT has given a staggering 22% return, Nifty Pharma has been up a meager 1.5% at the time when market, both in absolute as well as valuation terms, is sitting at record highs. How do you approach pharma now?
Well, the reason why pharma hasn't given such a staggering return as IT is relatively simple. Pharma is a much more complicated story. In case of IT services, we are seeing strong momentum across the board in terms of new orders that are coming in from the Western Hemisphere, from the developed markets. In case of pharmaceuticals, one has to look at very closely at the product pipeline, the kind of products that are getting approved by the overseas regulators like the FDA. And there are undercurrents in terms of, there are some companies which are benefiting as a consequence of the vaccine story, not too many of them in India, unfortunately. So, in a nutshell, this is a much more complicated story with too many variables impacting the participating companies. So, yeah, I mean, we don't have any exposure to Indian pharmaceuticals in our Asian model portfolio. We have very significant pressure on IT.
Okay. And besides IT, what are your other sector overweights?
Well, as I highlighted just in response to the previous questions, we have financials. Financials is, in fact, the biggest weight in the India allocation, in the India silo. We have both private sector banks, a very kind of dipping the toes kind of position in public sector banks, and also the NBFCs, predominantly in housing finance companies and also insurance. So financials is a very large weight. And we think that as a consequence of this economic rebound, that's one sector that's likely to have earnings estimate upgrades going forward in the foreseeable time horizon. Second, we also like IT services. We also like top-rung consumer discretionary companies. We are playing that through autos. And some of the commodities and even telecommunication, in fact, some of the conglomerates who also participate in these sectors. So, it's a pretty much, kind of a, I would hate to use the word crowded because that has different connotations today, but it's quite a significantly populated universe as far as the India silo in our Asian model portfolio is concerned.
Manish, a lot of changes are happening in the energy space. There is one thought that the world will move towards clean energy. But if I consider where fuel prices are, where oil prices are, where coal prices are, what is happening in the world? One side, everybody is committed to invest more in hydrogen, battery, and clean technology. But the price of renewable resources is at a record high. So who's getting it right? Who's getting it wrong?
You see, this trend of investment in renewable resources, that is something that's to stay here. And if an investor is investing for the next 5 years, 10 years, or 15, 20 years, this is a space that he would not be able to ignore. So renewable energy, electric vehicles, etc. Much of that is in the unlisted space in India right now, even though you have listed companies elsewhere in Asia, particularly North Asia. But this is clearly a space that investors would not be able to ignore. Now, what we're seeing tactically is a spike in fossil fuel as well, because of the developed market demand spike that we saw in the post-COVID period, which led to a production boom in Asia, particularly North Asia, China to be exact. And since Chinese demand for fossil fuel is about 50 to 60% of global demand, that clearly drove fossil fuel prices, and that situation is likely to persist for at least, I would say, the next 2 to 3 quarters. So it's basically a difference in the time horizon of investments. If an investor is keen on playing the fossil fuel or the energy scarcity for now, he would be well advised to invest in coal or oil over a next 2 to 3 quarter period. But at the same time, for a really long-term investor, and much of that money is actually coming in from the private equity space as far as India is concerned, he would not be able to ignore the green energy, renewable energy, and the electric vehicle space for any time in the foreseeable time horizon.
The stock on a tear today is actually Nalco. It's up 11%. Steel is not doing that well, but aluminum is. Vedanta is up 6%. Metal stocks are literally on a tear. Manishi, how far the metal rally will continue? Is it only supply, or it's a combination of supply and demand both?
Well, demand is obviously the dominating factor as far as commodity prices, even metal prices are concerned. Having said this, I must also point out that this is a sector that has been underinvested in all across the world, and particularly so in India and Southeast Asia. If you look at past, let's say, 5 years, capacity creation in these sectors have hardly gone up. So it's a combination of both, lack of supply creation and a sudden spike in demand that's leading to, the metal price spike that we're seeing today. Having said that, the recent resource prices, the fuel prices that we are seeing, that's a very important input to these sectors. So I think in the near term, one would have to be cautious. One would have to look for those companies which are able to pass on historically, those companies which have had a track record of being able to pass on their cost increases to their customers. So, that would be our stance, as far as the metal sector goes.
Manishi, we're going to leave it at that for today morning. Thank you so much for joining us here